All right, let's be honest. Earnings calls can be pretty dry, right? They're just packed with jargon and numbers. But if you look closely at the latest report from asset manager Pollen Group, there's actually a fascinating story in there. It's a story of insane growth, some really bold strategic moves, and massive ambition. So today, we're going to pull that story apart piece by piece. Let's get into it.
Everything really kicks off with this one number, 30%. Just let that sink in for a second. That's how much Pollen grew their assets under management, or AUM, in a single year. In this industry, that's not just good, that is a huge deal. So the big question is, how in the world did they pull that off?
You don't just toss a word like transformational around lightly. The company's own leader, Lindsay McMurray, used it. That signals a real, fundamental shift, a moment where the business just completely leveled up. She says it's down to strong execution. So let's dig into what that execution actually looked like.
Yeah, so this wasn't some kind of happy accident or a lucky break. This growth was the direct result of a few very specific, very big wins. And the numbers we're about to look at are going to paint a really vivid picture of just how massive this year was for them.
Okay, so let's break this down. The scale here is what's so impressive. Their total assets under management shot up to £7.1 billion. Now that's the total value of everything they're managing. But the number that really pays the bills is the one next to it, $5.2 billion in fee-paying AUM. That's the capital that's actually out there generating revenue, which, by the way, hit £114 million.
So where did all this new money come from? Right here. Check out this fundraising success. Their private equity fund was aiming for €1 billion. They brought in €1.5 billion. Then their private credit fund did even better, blew right past its €1 billion target to raise $1.8 billion. They didn't just meet their goals, they absolutely smashed them.
Bringing in billions is one thing, but how do you turn that into steady, reliable profit? Let's pop the hood and take a look at the engine room of their business. It's actually a lot more straightforward than you might think.
And just a quick refresher, so we're all on the same page. Assets under management, or AUM, is the key metric. The easiest way to think about it is like the raw fuel for their business. The more that fuel they have, the more fees they can generate. It really is that simple.
And this shows their money-making machine perfectly. It's a really simple, elegant three-step process. First, they raise all that money, and they lock it in for the long term, like 8 to 10 years. Second, they charge a fixed management fee on that cash, which gives them this incredibly stable, predictable income. And third, if they absolutely knock it out of the park with their investments, they get to earn performance fees, a nice slice of the profits.
And hey, you don't have to take my word for it. The CFO himself, Crispin Goldsmith, really hammers this point home. He talks about how predictable their management fees are. For anyone investing in a company, predictability is gold. It means you can see where the money is going to come from, and the market absolutely loves that.
But here's where the story gets a little more interesting, a little more complicated, because as we all know, growth on this scale, well, it doesn't come for free. To get this big, this fast, you've got to spend some money. And Pollen definitely did.
A 25% jump in costs in just 1 year. Now, that's the kind of number that can make investors a little nervous. You see that and you immediately have to ask, is this a sign that spending is getting out of control, or is there a bigger strategy at play here?
Well, it turns out it's very much a strategy. The company is pretty clear that this spending is a deliberate investment. They're hiring more salespeople to bring in even more money. They're building out new teams to handle the next round of even bigger funds. Simply put, they're spending money today to build a much bigger, more profitable company for tomorrow.
Okay, now we get to what is, for me, maybe the most strategic and maybe controversial decision in this whole report. It's about how the company shares the rewards of all this success, and it has a direct impact on shareholders.
So to really get this next part, we have to talk about something called carried interest. The simplest way to think about it is, it's the big bonus. It's the share of the profits that the fund managers get when they do an amazing job for their investors. It's the #1 incentive in this entire industry.
Which brings us to this really important question. If carried interest is a huge source of profit for the company, why on earth would they decide to give a bigger piece of that pie to their employees, which means a smaller piece for the company and its shareholders?
And just look at how big a change this is. Under the old system, the company, the house, kept a fixed 25% of all those performance fees. Pretty straightforward. Under the new model for their latest fund, that share drops all the way down to 17%. That's a serious cut in the portion of profits flowing directly back to the company.
So what's the logic? Well, management is framing this as playing the long game.
They're saying, look, we need to reward our all-star team for that incredible fundraising, and we need to make sure that top talent doesn't leave. The bet is that a happier, more motivated team will generate so much more profit overall that even the firm's smaller slice will end up being bigger in the long run.
So, after this absolutely transformational year full of growth and some really bold changes, what's next? Are they going to take a breather? Not a chance. They've already set their sights on another massive goal.
10 billion pounds. That is the next mountain they're setting out to climb. This company is not planning to slow down. They're basically signaling to everyone that the explosive growth we just saw wasn't a one-time thing. It's the new standard they're chasing.
And they've got a really clear roadmap to get there. The plan for 2026 is pretty simple. Keep raising money, keep investing in the people and technology to support all that growth, and, most importantly, put all the cash they just raised to work so it starts generating those sweet, predictable management fees.
And all this really leaves us with one final big question. Pollen Street is on a rocket ship right now, but that kind of speed always creates new challenges. The core tension in their story is a classic one. Can they successfully balance the need to invest in growth and reward their top people while still delivering the long-term value that shareholders expect? That, right there, is the £10 billion question.